Hi, this is Mike Barrios of Integrity Home Finance. Today's discussion will be $8,000 tax credit. What can you do with it? Now, up to November 30th of 2009, the government is giving $8,000 to any first-time home buyer. Anyone that hasn't purchased a home in the past 3 years or hasn't claimed any mortgage interest in the past 3 years is considered a first-time home buyer. Now, there's a question whether or not you can or cannot use $8,000 as a down payment. Now, in an FHA loan, the typical guideline is that the buyer needs to come in with a 3.5% down payment. The $8,000 tax credit cannot be applied towards the initial 3.5% down payment. However, it can be put towards a loan as an additional down payment, or it can be put towards a loan for closing cost or to buy down the interest rate. Now, I'm going to walk you through a couple different scenarios of what that $8,000 can do for you or your buyers. Also, feel free to forward this link to anyone that is interested or that has any questions or is in the market to buy a house. So let's take a $225,000 purchase price at 5.75. Roughly, this is how much a client would need to come in with. It's just an estimate, of course. $15,519. So the down payment, 3.5% of 225 is $78.75. So let's put these scenarios next to each other. And the second scenario, we're going to increase the down payment by $8,000 and see what that would do to our loan. So our initial down payment is $78.75 plus $8,000. Now the down payment is $15,875. Now that changed our payment a little bit and our closing cost. Now let's compare this one as well. Make sure that's there. Now, what if we take that $8,000 and instead of putting it down towards a loan, we buy down the rate permanently? We get the rate to 4.25. However, now we pay 1.5% roughly to buy down the interest rate from 5.75 to 4.25. What would that do? Buy down. Okay, now here we have it. This first column is just the regular loan, $225,000, 5.75. This one is $225 and increasing the down payment by $8,000. That makes a difference of $60 a month, which isn't too much. Or if you do a permanent buy down, instead of getting a 5.75 interest rate, you buy down to 4.25. Now that is $202 less per month. Now every scenario is different for everyone. Me personally, I think right now I would prefer to have $8,000 in my pocket. However, $200 is also a lot of money. So if you take 202 times 360, if you take this scenario and you do a permanent buy down from 5.75 to 4.25, but of course, as you can see here, the closing cost is to come in with is a little bit more. You save $72,720 in the term of the loan. And what you do to figure that out is $202 times 360 months, which is 30 years. Or you could choose to increase the down payment an additional $60 and an additional $8,000, and it would make a difference of $60 a month. Hopefully this little brief scenario makes sense, and if you have any questions, please call me at 909-945-8155, or feel free to email me at as in Mike, BERRIOS @ihfinance.com. Thank you.